Hello, good evening everyone, and welcome to this session on technical and also fundamental analysis. We'll be talking today on how you can analyze the markets and come up with decisions of where to enter and exit the markets. So that's the topic for today, technical and fundamental analysis. We'll start with technical analysis. Now, this is just a few textbook definitions for technical analysis. One textbook definition for technical analysis is a method in the market activity, and the market activity could be the forex market, the commodities market, the stock market, or indices. So it's just a method of studying the market activity, whichever market you're trading, and the patterns on a chart to discover trading opportunities. So that's one textbook definition. Another textbook definition for technical analysis is a graphic representation of price and volume movements over time. So it's a graphic representation of price and volume movement over time. And the final textbook definition for technical analysis is forecasting of market prices by means of analyzing or analysis of data generated by the process of trading. So these are just a couple of textbook definitions for technical analysis, but the simple way I just like to look at technical analysis is just analyzing the charts to look for trading opportunities. So just basically chart analysis. Analyzing the chart to look for opportunities of where you're going to trade or where you're going to exit the market. But these are just a couple of textbook definitions for technical analysis. Now, technical analysis is not just useful to the short-term or intermediate-term trader, but it's also very, very useful to the long-term investor as well. Obviously, as a trader, as you all know, trading and investing are two separate things. And for the trader, technical analysis is very crucial. For the investor, the long-term investor, it's not as crucial, but it can also be very helpful for the long-term investor. Now, to be a successful trader, and obviously as we know, trading is short-term getting in and out of the market. So to be a successful trader, it is vitally important to learn how to study charts, because inability to read, understand, and interpret the charts of the markets you're trading leaves you severely handicapped. And obviously this involves you reading books and articles on technical analysis, because it's continual education, which is very important, that will make you become a successful trader. So the only way you can be very proficient and very good at interpreting and analyzing charts of the markets is for you to do your own private study. You need to read, you need to do some study, you need to read, because you cannot analyze the charts as a trader. You're not going to be very successful. It's going to really severely handicap you. So chart analysis and technical analysis is extremely crucial to your success as a trader. And like I said, you need to do some work yourself. Now, it's also important to remember that technical analysis will not predict the future. Very, very important. Technical analysis will not predict the future, but it will help you assess the market and make logical decisions. And that's the problem I tend to find with some traders. They feel because they have analyzed the markets properly, they feel that the markets has to go the way they have analyzed it. And they always forget that technical analysis will predict the future. You're just going to assess the market, make logical decisions. And if you can consistently make logical decisions as a trader, that would significantly improve your chances of being successful trade. So always remember that. Technical analysis will not predict the future. Now, one of the most important aims of chart analysis is to determine the trend of the market. That's the trend of the market. So always remember that one of the most important aims of chart analysis is to determine the trend of the market. And a very old and popular saying in trading is, the trend is your friend. Always remember that. The trend of your market, which could be up, down, or sideways. And trading in the direction of the trend significantly increases your odds of success. And that's why it's important that the first thing you want to look at when you look at the chart is which way is the market trending. Is the market trending up? Is it trending down? Or is it trending sideways? Because if it's trending up, you're looking to buy. If it's trending down, you're looking to sell. And if it's trending sideways, you keep out of the market. So the first thing you want to do when you look at the chart or when you analyze the chart is to determine the trend of the market. And that's because the trend is your friend. Now, indicators, we're going to talk a bit about indicators. And indicators are defined as any mathematical calculation that is represented graphically upon a chart is called an indicator. So any mathematical calculation that is represented graphically upon a chart is called an indicator. And again, just to simplify it for you, I always say if you see anything on a chart other than price and time, anything on a chart other than price and time is an indicator. So that's another simple way to think about indicators. So whatever you see represented on the chart, if it's not just a simple price and time, anything other than price and time is an indicator. Now, indicators, are very, very useful and they help in the analysis of the market. So when you're looking at the charts and you're trying to analyze the charts, indicators are very helpful in your analysis. But it is important not to use too many indicators on your charts because this can lead to confusion and it can hamper your trading. So it's best to use 3, maximum 4 indicators on the chart. In fact, I tend to use a maximum of 3 indicators when I'm analyzing a chart. In fact, more often than not, I only use 2 indicators when I'm looking at a chart. So it's very, very important because the aim of trading is to make quick decisions and you need to decide quickly when to get into the market and when to get out of the market, and you don't want to start analyzing too many indicators and they start to conflict each other and you just get yourself confused. So use 3, maximum 4 indicators on the chart. Don't go too crazy with it. Now the key with indicators is that they're used to determine entry points and exit points in the market. And again, that's really what trading boils down to. As a trader, all you're just asking yourself is where do I get into the market? And once you're in the market, how do I get out of the market? And the indicators really help you make this decision as to where you're going to enter the market and where you're going to exit the market, either to take a profit or to cut your losses. So that's where indicators come to play, and that's why they're very helpful to you as a trader. Now, there are different types of indicators, and I always add this to my presentation when I speak to traders or when I discuss trading with traders. I always say if you speak to 1 million traders, you will get 1 million different ways to trade, 1 million strategies, 1 million different ways to use indicators, and so many indicators. So there's so many indicators out there that you can use, but don't fall into the trap of trying to master them all or trying to use them all. Just find 2 or 3 that you're familiar with, that you're very good with, and you use them well. So always remember that. Don't try and know all of them. So like I said, there's so many indicators out there, and don't get yourself all twisted and confused. But I'm just going to show you a few of the commonly used ones. And again, if you're going to use indicators, it's best to use the ones that are commonly used. Don't use the ones that just you and someone else at the end of the world uses. So if it's just you and 2 other traders in the whole world that use that indicator, you're probably not going to be very successful with that indicator. So it's best to use the indicators that are used commonly among traders around the world. And these are a few of them that are commonly used around the world. You have things like candlesticks. You understand candlesticks and you know how to interpret candlesticks. They're very popular and they're very nice. Another indicator that are commonly used. The market is very important. Market support and market resistance indicators in the market provide you with very good points of entry into the market or exit in the market. Moving averages also very important. They're very, very popular indicator, moving averages, and they're widely used around the world. So moving averages is not very important indicator for you to study and learn to use. Pivot points are my favorite indicator when it comes to day trading. So pivot points are another very good indicator. A volume indicator, also very popular. Fibonacci retracement and Fibonacci analysis are very popular. Oscillators are popular indicators. Williams percentage R. So these are just some popular indicators. So this is just a list of some popular, commonly used indicators which I would advise you take the time to do some private study on each of them and learn how to use each of them. But like I said, there are 1,000,001 indicators out there, but these are some of the ones that are used frequently and commonly and are quite reliable indicators. So among all these types of indicators, when you see all these indicators, like I said, there's so many of them, but again, they're categorized into two types. So you have what we call the leading indicators. So these leading indicators are designed to lead price movements. So they sort of try and give you a good idea where the market is leading, because they're designed to lead price movements. But again, it's not a 100% guarantee. So don't think because you're using leading indicators that you're 100% sure where that market is going. So although they're leading indicators, they might give you an idea where the market is going, but again, remember there's no guarantee. So leading indicators, some examples of leading indicators are Commodity Channel Index, or commonly called CCI index or CCI indicator. So the Commodity Channel Index is a good leading indicator. RSI index, so could possibly be going. The Commodity Channel Index, the Relative Strength Index, and the Williams percentage R. And then we also have lagging indicators. Now, just like the term says, they tend to follow price action. So this follows the price action, or they're sometimes called trend following indicators, because the market and they're just following or lagging behind the market or following the trend of the market. So they're trend following indicators. And some examples of lagging indicators are the moving averages. So the moving averages is a very common and a very popular lagging indicator. And obviously the MACD, the moving average convergence and divergence indicator, is a good lagging indicator. Just a brief fundamental analysis. Just not complete fundamental analysis. Because once you know that there's technical analysis, there's also what we call fundamental analysis. Now, fundamental analysis, this is the examination of the underlying forces that affect the well-being of the economy, industry groups, and companies. And that's a very important definition, because like the definition states, when you're doing fundamental analysis, you need to examine how the economy as a whole is performing, how the industry groups are performing, and then the individual companies within that industry group. So that's why that definition is very important. The economy as a whole, the industry groups within economy, the companies within industry groups. And the goal of this is not the profit price movement. That's why you do them. You want to derive a forecast as to what is the price of the company stock, given the analysis you've done, and decide whether they're undervalued, and then you can buy them when they're undervalued and profit from future price movement. So as stated in the definition, fundamental analysis is done on 3 levels, starting from the economic level, then the industry group level, and then finally the company level. Now, the advantages of fundamental analysis is that they're very good for long-term investments based on long-term trends. So this is crucial, because fundamental analysis is not very helpful for the trader, where the market, you have to make decisions based on things that happen minute by minute, hour by hour. So fundamental analysis is not very helpful for the trader, but they're very good based on long-term trend. Also, analysis are very good for spotting valuable stuff because you can get diamonds in the rough. And obviously, by the time you've done the proper fundamental analysis in terms of analyzing the economy, the industry, and then the company, you will develop a thorough understanding of the business you're analyzing. So these are the advantages. But the disadvantages of fundamental analysis is time consuming. So it takes you a lot of time to do all this analysis of the economy, the industry groups, the company. Obviously, when you're looking at the economy, you're looking at unemployment figures, GDP, growth, consumer price index, interest rates, then industry groups, you're looking at how well the industry group is going to do management board. So it's a time-consuming exercise. And that's why, you as a trader, where you have to make quick decisions, fundamental analysis is not going to be very helpful for you. It's time-consuming. So the opportunity is to look at the same data, but one can come up after analyzing the data and then stop. Somebody analyzes the same data and there's overview based on their assumptions. So again, the analysis of when it comes to fundamental analysis, it's a subjective thing. What is what you have, the analyst bias. Analyst bias is the fundamental analysis because the majority of the information that goes into the analysis comes from the company itself. So I believe the rubbish. Okay, so I'm just going to show you a chart. Just have a look at things I'll talk about technical analysis. So we'll just play with a chart and see technical analysis in play. Like I said, this presentation is just to give you some basic understanding of technical analysis. We're not going to be going into trading strategies and all that, but it's just a brief to let you know what technical analysis is all about. Okay. So I'll just show you this. This is just a trading platform. Like I said, dkbMARKETS, we have our own trading platform, and you can open accounts with us and have your own trading platform. But this is the Euro-US dollar. So you can see, I'll just make this a bit bigger. So you can see this are just candlesticks. So you can see all these things on the chart, what we call candlesticks. And again, you need to learn how to interpret candlesticks. So this is candlesticks. I do master classes for those who want to go to train in depth and go to things in detail. And so live account holders with dkbMARKETS, you do have live sessions for account holders where we go to some of these things also. Just make it a bit smaller. And then this red line you see here is the moving average, so you can see how it's following the market. The candlestick represent the prices of the current market. And then you can see the red line is the moving averages just following the market. And then you also then have the pivot points, which I tend to use a lot. So the yellow line, this red lines, and this green lines here are the pivot point lines. They're the pivot point lines used when I use them in day trading. They're only used for day trading. And this is a 5-minute time frame chart for the Euro-US dollar. So I'm putting it to help me interpret where I'm going to sell, where I'm going to market, and where I'm going to get out of the market. And like I said, it's very important you learn how to interpret and use these things in detail because they're going to help you in your analysis of the market. So those are our contact details for dkbMARKETS. You can either go to our website, dkbmarkets.com, email us at info@dkbMARKETS, join us on Facebook or join the Facebook group. You can follow us on Twitter, or you can see previous video recordings of previous presentations on our YouTube channel, youtube.com/dkbMARKETS. Okay, so just to recap, like I said, technical analysis is you analyzing the charts to make or help you to make good trading decisions. So you want to learn how to analyze the market, especially if you're a trader trading the market. So as a trader, if you're trading the market, you need to know how to get in and out of the market, how to make decisions on the market, and that really will make you successful. It's you knowing how to make logical decisions. Because remember, I said, technical analysis will not predict the market. It will not predict markets. So remember that it will just help you make logical decisions. It will help you make logical decisions. And if you can make consistent logical decisions, you're going to do very well as a trader. That's it. On to any questions.